My name is Michael Grandy. I'm a certified public accountant and I'm a professor at Providence College. This semester I'm teaching a graduate class. This is the graduate version of managerial accounting. And today we're talking about chapter 11 from the Garrison, Noreen and Brewer textbook, the 17th edition. And specifically, we're talking about responsibility accounting. So this is responsibility accounting. And essentially, it's really focusing on two things in this chapter. There's a couple of other things going on, but I'm primarily concerned about two things: return on investment and residual income. And these are two methods that are used to evaluate the performance of managers in business. And I've said in my PowerPoint presentation that managers make decisions based upon how they're evaluated. Now, these two methods that we're talking about here, return on investment and residual income, are relatively simple calculations, somewhat universal in their applicability, but you really need to understand that out there in the working world, especially when we're talking about upper level management, there are many, many more factors that go into performance evaluation than just return on investment or residual income. The essence of this chapter is to do two things. Number one, teach you how to make these calculations and how these calculations are performed. And secondly, and what I find the most interesting, is driving home the point that managers make decisions based upon how they're evaluated. Managers may have the opportunity to invest assets in a particular activity or endeavor, and based upon the expected revenues and expenses, they're going to make a decision. If they're evaluated on the return on investment calculations, they may reject the proposal. But if they're evaluated using residual income, their decision may change and they may decide to go forward with the project. So in essence, as we move towards some of the other problems, we're going to see managers making a decision whether or not to accept or reject a business proposal. But let's first look at some simple problems, and we're going to look at problem 11-17. So this is problem 11-17. That's specifically chapter 11, problem number 17. And it's in your textbook on page 528. And this is the Joel de Paris problem. And what you're given here is you're provided with a comparative balance sheet, and you're provided with an income statement. And the question goes on as follows. The company paid dividends of $15,000 last year. The investment in Boyson SA on the balance sheet represents an investment in the stock of another company. The company's minimum required rate of return is 15%. So the first question here is asking to calculate average operating assets. And during my PowerPoint presentation, we defined average operating assets. We first began with the definition of operating assets. And those are the assets in the company that are operational. They are used primarily to generate operating income in the company. And I will start out by saying operating assets do not equal total assets, nor do they equal current assets. So they are selective assets, specifically items such as cash, accounts receivable, inventory, property, plant, and equipment on a net basis. That means after we subtract accumulated depreciation. And there may be some other operational assets. Now, we are excluding from that calculation a couple of items. Number one, we are excluding short-term investments, long-term investments, loans in other companies, and anything such as land that is held for speculative purposes. Now, land that is used to keep our building on, the land, the land that our manufacturing facility sits on, that's operational land because it is part of our building, part of our property, plant, and equipment. But sometimes a company may buy a piece of land thinking that if I buy it today, it'll be worth 3 or 4 times what I paid for it. Well, that is simply just another investment that the company has. So what we want to do here is define average operating assets, as I just did. The second, and we'll do this as follows. Again, it's comparative, and there tends to be a bunch of numbers here, but I do want to go through it. And you've got beginning balances, and you've got the ending balance, because let's remember they're average, which means beginning balance plus ending balance divided by 2. So we have cash, and I'm going to drop the zeros here, of 140 and 120. We have accounts receivable of 450 and 530. We have inventory of 320 and 380. And then we have property, plant, and equipment net. Always remember to subtract accumulated depreciation of 680 and 620 for a total of 1590 and 1650. Add the two together, divide by 2. You got to put the parentheses in there, right? And this is going to equal 1620. Average operating assets, 1,620,000. What has been excluded here is the land undeveloped and the investment in Boise. So we have average operating assets, 1,620,000. The second question is asking us to calculate return on investment. It says calculate return on investment, and there's 2 ways of doing it. Okay, and the first way is the simplest way, which I use, and that's net operating income divided by average operating assets. Now, please, the definition of net operating income is not net income. Net operating income is income from operations before interest expense and before income tax expense. But the problem here is asking you to calculate it in terms of margin and turnover. And luckily, they give you an income statement to do that. So margin equals net income, net operating income, that is, we'll still say NOI, divided by sales. And you know that turnover equals sales divided by average operating assets. And if you know your algebra, you know that these items cancel out. Okay, but right now the margin is 10%, and the turnover is 2.5%. So we have 10% times 2.5, and that's not a percentage, that's the number of times it turns over. Number of times average operating assets turn over 2.5 times a year. So it's 10% times 2.5 is 225%. The other way you could have said it was to take net operating income, which was from the income statement, which is 405, divided by the average operating assets of 1,620,000, and that would have been 25%, right? Because that's net operating income divided by average operating assets. The third question here is asking us to calculate residual income. So we know that residual income equals net operating income minus average operating assets multiplied times the minimum required return on average operating assets. So we know that the net operating income was 405, and we're going to subtract the summation of 1620, 1,620,000, times what they asked us was the required minimum, which was 15%. So return on investment is going to equal $162,000, 162, be consistent with dropping the zeros. So it's a great little problem because number one, it enforces the definition of average operating assets and where you need to get net operating income from. And secondly, it has a very simple calculation on return on investment and residual income. The next problem that I'd like to take a look at is exercise 11-14. This is exercise 11-14. And again, this is chapter 11, exercise 14. Let me read it. For you, it's on page 527 of the 17th edition. It says, selected sales and operating data for 3 divisions of different structural engineering firms are given as follows. So we've got Division A, Division B, and Division C. And we're provided with sales, average operating assets, net operating income, and minimum required rate of return for all 3 divisions. So the first item is asking us compute the margin, turnover, and return on investment for each division. So we've got Division A, and the margin, I'm going to subtract, move that right there. So we're going to have, first calculation over here is going to be margin, and the second one is going to be turnover. And we know that margin times turnover equals return on investment. So for Division A, they have provided us with the net operating income of $600,000, and the sales are 12 million. And we're going to multiply that times, again, the sales divided by the average operating assets, which is 3 million. And you're going to have a return on investment of 20%, because you know the margin works out to be 5%, and the turnover works out to be 4. So 5% times 4 is 20%. So Division B, do the same thing. Net operating income of 560 divided by sales of 14 million, which is going to be 4%. And you've got the turnover, which is 14 million in sales, divided by average operating assets of 7 million. That's obviously a factor of 2. 4% times 2 is 8% return on investment. And then item C, Division C, has net operating income of $800,000 on sales of 25 million, which is a percentage of 3.2%. That's the margin. And their turnover is again going to be 25 million in sales divided by $5 million in average operating assets. That's a turnover of 5. So 3.2 times 5 is 16%. Those are your return on investments. Clearly, Division A is got a very high return on investment. The second item here is item B, compute the residual income for each division. And again, we remember what that formula is. Residual income equals net operating income minus the average operating assets times the minimum required percentage of return. So for Division A, I'm going to say equals residual income, right? For Division A, they have actual net operating income of 600,000. They have $3 million of average operating assets. And the problem said that they have a minimum required rate of return from that chart of 14% times 0.14. So this number here is what, 420, right? So 600,000 minus 420, they've got $180,000 of residual income. Division B, their net operating income is 560. They had, I'm sorry, 700,000. And they had average operating assets of 7 million. They have a minimum required rate of return of 10%. So that's $700,000. I'm sorry, I apologize. I did have this right. Their net operating income is 560,000. They have average operating assets of 7 million. Their minimum required rate of return is 10%. So they have $700,000 of minimum required rate of return. 560 minus 700 is a negative $140,000. They have negative residual income. And then item C, division C, has actual net operating income of 800,000. Their average operating assets were 5 million. They had a minimum required rate of return of 16%. That number is $800,000. You can see they had 0 residual income. Okay. So again, division A is looking good. It has a very good return on investment. It also has the highest residual income. Let's take a look at the third question here. And the third question is asking, assume each division is presented with an investment opportunity that would yield a 15% rate of return. If performance is being measured by return on investment, which division or divisions will probably accept the opportunity? So let's remember that the return on investments for A, B, and C, and we calculated these at the beginning, right? They were 20%, they were 8%, and they were 16%. So let's remember that managers make decisions based upon how they're evaluated. So if the managers are evaluated based on return on investments, they're only going to pursue projects that do what? Either maintain their current return on investments or increases their return on investment. So we're looking at a project here that's going to generate, let's read it again, an investment opportunity that would yield a 15% return on investment. Only 15%. So what does it do? Well, if it's a 15% return, then this division A is already at 20%, a 15% return. He's going to reject because 15% is going to bring him down below 20. He wants a 20 or above. So what about division B? Division B only has an 8% return. This new project would generate a 15% return. This project would increase. So this guy is going to accept it. And then lastly, let's look at division C. Division C is currently earning a 16% return on investment. This new investment opportunity is going to generate only 15. It'll bring him down slightly, but bring him down nonetheless. So this person, division C, is going to reject it. The only person that's going to go forward with it is division B because it'll improve his situation. So let's read the next question. The next question is, if performance is being measured by residual income, which division or divisions will accept or reject? So again, we're looking at these three divisions, and we're looking at residual income right now. And in order to make this decision, we need to look at what their minimum required rate of return is. Now, that's set by upper management above these people, said minimum required. This is what we expect of you. This is what we expect of you. Anything above it is great, but this is what we expect. So let's go back to the given problem. And it says right here that division A has a minimum required rate of return of 14%. Division B is expected to get at least 10%. And division C is expected to get 16%. So this project is going to generate 15% rate of return. So any percentage above their minimum required rate of return is going to increase their residual income. So if the project's at 15% and division A's minimum required rate of return is only 14%, they're going to accept it because they're going to have a 1% increase in their residual income. What about division B? Division B's required rate of return is only 10%. The project generates 15%. So they're going to have an improvement as well. So they're going to accept it. But what about division C? Division C's minimum required rate of return is only 16%. It's a 16%. The project only generates 15%. So they're going to go backwards. So this one is going to reject the project. So you can clearly see based on this analysis that if a manager is evaluated differently, they're going to have a different answer. So managers make decisions based upon how they're evaluated. So that's the two problems I wanted to cover here. During our synchronous class, I'm going to go over another problem that has a little bit more depth to it, but we'll save that for our synchronous class. So thank you.